Global financial markets have been trading cautiously for the second day straight in anticipation of two crucial reports from the United States. They will be available today, but stock markets will shape their sentiment only on Thursday. The influence of these reports could even last for a few next weeks. A lot will depend on a particular currency and its region. Yesterday, China's authorities implemented the most significant reduction in the mortgage rate in history. The measures taken should stimulate the real estate market, which is heavily indebted to the even got stuck in defaults. Besides, the authorities aim to prop up the economy and revive consumer demand. In response to the decision of the People's Bank of China, stock indexes on the domestic stock exchange rose by almost 2% overnight. The Chinese yuan has recovered in price to almost a 3-week high. On the whole, investors did not display zeal about this move. Experts said that such measures are clearly not enough to fully support the economy. So the truncated version of the stimulus had the opposite effect. Instead of optimism, it provoked a new wave of concerns about malaise on China's economy, and this has already had a negative impact on the commodity prices as traders analyzed conflicting demand signals from the world's largest economies. Troubles in China were also the reason why the Brent crude price did not sustain at around $83 a barrel and went down. The main culprit of the fall in oil prices is the expected expansion in the US oil inventories. Crude oil is likely to extend its downward move. If US oil stocks shrink, oil prices will instantly rebound to $83 a barrel. At the same time, Brent crude did not settle at around $83.50 today. Moreover, oil traders decreased their long positions on crude oil today. All in all, oil prices have already declined by 1.35%. Nevertheless, despite the ongoing two-day drop, the bullish trend is still valid. To enable its further development, the price needs to settle above resistance of 83.5. Until then, Brent crude remains under selling pressure. US stock futures opened today in the red. At the same time, all three benchmark stock indexes have been declining for the second day in a row, mainly due to the fall in the shares of high-tech giants. Due to the strong bias in a capitalization towards the 7 heavyweights, the influence of these companies is very high. The quarterly reports are anticipated as high-impact events for global investors. The next such important report will be released after the closing bell. The dynamics of the US stock market on early Wednesday look weak and without a clear-cut direction. As a result, the S&P 500 opened the new year trade lower, declining towards the first technical support of 4,951. And there is also a slight bullish impulse on the chart. If it strengthens, the index price may climb towards the resistance of 5,046. As we already mentioned earlier, the main catalyst on Wall Street and other regional stock markets today, two reports. These are the minutes of the January meeting of the Federal Reserve and Nvidia's report on profits and losses for the fourth quarter. The market views the chipmaker as a leader in artificial intelligence, given that Nvidia is one of the top 3 companies by market value. Its report is especially important, since only a few mega-cap stocks have accounted for most of the market's recent gains. Any potential decline in Nvidia's earnings, especially amid lofty expectations, could trigger a broader pullback in the stock. The chart below clearly shows how the stock earnings in the third quarter of 2021 and 2022 differ from last year's figure. As investors cut on long positions of tech stocks ahead of the report, Nvidia's shares fell by 4.4%, its biggest daily percentage decline since October 17 last year. The second important event of the day is the minutes of the Federal Reserve meeting on January 31st. And its markets will try to find clues about the agenda for monetary policy in the United States. The document will show possible changes in the sentiment among Fed policymakers, and the most important thing is the direction of these changes. As investors mull over the prospects for the U.S. Central Bank's benchmark rate, the average interest rate on the 30-year mortgages in the United States has jumped above 7%. Its level followed an increase in Treasury yields. Thus, over the past year, it has risen to the highest level since the beginning of December 2023. It's clear that increased mortgage interest rates have hit the housing sector hard. As a result, mortgage applications plunged by 10.6% in the United States, recording their worst fall this year. At the same time, the Federal Reserve remains the world's leading central bank, and the US dollar remains the main currency. Meanwhile, the yield on the US Treasuries has fallen to the level of global peers. It put pressure on the US dollar. Its index slipped below 104 points today. The decline in Treasuries and the greenback followed lower than expected inflation data in Canada and wage growth in the Eurozone. Also, in Europe, record high levels of car sales were recorded in January. Car sales jumped by 12.1% compared to the same month last year, according to an Auto Industry Association report. Cars were mostly sold in the five largest countries of Europe: Germany, the UK, Italy, France, and Spain. However, positive economic data could not support the euro in the face of the strengthening US dollar. It seems that investors have not yet lost hope that the Federal Reserve will cut rates at its March meeting. The decline in Wall Street indexes allowed the greenback to adjust its price recover around 104 points and put pressure on its European counterpart. Perhaps one of the speakers of the US Central Bank will also clarify today regarding the timeline for the rate cuts by the American regulator. If monetary easing is postponed until the summer, such prospects will lead to a rise in the US dollar. As we can see today, during the upward move from the support level of 1.07, the euro-dollar pair rose above 1.08. During the American session, the instrument is trading higher at about 1.0810. So, we assume the euro-dollar pair will move towards 1.09. However, it's too early to talk about a change in the market sentiment. For this reason, it's possible that the price will return below 1.0800 on the daily time frame. Hence, traders will increase short positions on the euro. And you have watched the market review by InstaForex analyst for Wednesday, February 21st. Subscribe to InstaForex TV channel, and we keep you updated on recent market developments. Don't miss our videos. Your feedback is appreciated. See you online tomorrow.